Hello everyone, welcome to Accounting 210. I think this may be the last video for this semester. Before I talk about final review, I want to say I really appreciate, I want to say thank you for the good semester. It's a tough semester, but you all work really hard with me. So I want to say thank you for all the good time, all the good memories, and then let me know if you have any question, for the final, for accounting, or for anything that I can help. Okay, so let's look at the package before I get too emotional, right? So this is just the review note I wrote by myself. You can have your note. So just to write down what do you think is important. I think those things are important. I haven't finished making your final exam. Once I have a better idea with the final, I definitely post to Blackboard before the weekend. So let's get started. Chapter 1, if you go back to chapter 1, you will find out actually the main thing, if you ask me, I would say focus on the difference of the managerial accounting and the financial accounting. We have been talking about managerial accounting, so you just kind of know it's not required by SEC, it's not audited by the GAAP or whatever. So the main difference is on textbook page 5, learning objective 2 in first chapter, I think. That's the main thing, general idea, nothing really important or fancy in chapter 1. Chapter 2 actually is starting getting heavier, right? It has a lot of concept. Basically, all the concepts are kind of covered in that chapter, a lot of concepts covered in the chapter. So first thing you need to know, there are 3 types of companies. A service company, manufacturing, and then merchandising. There are differences among these 3 types, but we said, hey, one of the main differences is the inventory in the balance sheet. In the inventory, a service company most likely no inventory. Manufacturing, you have direct labor. Manufacturing, you have raw material, working process, finished goods, and then merchandising, most likely just the finished goods, they are ready to be sold, right? We also talk about value chain. This is just the production part. You also have R&D, marketing, distribution, all those parts in the value chain. Talk about that. We said besides the production part, besides the production in the value chain, all the other activities, actually, they are period cost. Actually, R&D, marketing, those things are all period cost. Talk about that later, but link the value chain to product cost and the period cost. We said inventory is important, is a part of your asset in the balance sheet. The other reason why it's important, because when inventory is sold, it became cost of goods sold in the income statement. So the keyword, it has to be sold. Why I say that, if you made 10 units, you made 10 units, so you have 10 units as the ending at the inventory, but you only sold 8 units, then you can only expense that 8 units. You cannot expense all of these 10 units. You can only expense the 8 units as cost of goods sold. Okay, so this is important. It's only cost of goods sold, right? It has to be sold. A product cost, there are three parts, direct material, direct labor, and manufacturing overhead. I don't worry about direct material, direct labor, but I think manufacturing overhead is the one you may want to really reread your textbook. So what is the product cost and the period cost? I believe we watched the video. So everything happened in the manufacturing department, in the plant. That is our product cost. It goes to your product as the inventory and will be expensed when it's sold. All the other costs happen outside of the manufacturing department, you know, like a CEO salary or accountant salary, sales salary, you know, all those things will be our period cost, and then they will be expensed in the same period, and then will be in the income statement. Manufacturing overhead is kind of really want to pay attention, you know, because it's hard to measure 3 types: indirect labor, indirect material, and then other manufacturing overhead like rent, you know, like insurance, those things. So make sure you really know manufacturing overhead. We also talk about direct cost and the indirect cost. The difference is whether you can trace the cost to the cost objective easily, right? If you can trace it, it will be direct cost. If you cannot trace it, it's indirect cost. We have to allocate. Remember, once you go to chapter 3, we have to allocate the indirect cost. And then we also said you have to know how do you get cost of goods sold. For the merchandising, you know, it's just a very straightforward. The beginning plus purchase equals to ending plus cost of goods sold. I always say you open your refrigerator, you find out there are 4 eggs left in the refrigerator. That's your beginning inventory. And then you purchase 3 eggs. So totally available for sale is 7 eggs. Either they will be sold or they became ending inventory. And you found out you only had 2 left. Then that means you sold 5 eggs, right? But for the manufacturing, the calculation is more complex. You have to do 3 steps. First is you have to get the direct material used. Then you calculate the cost of goods to account for, you know, we have cost of goods account for. Then you subtract the ending working process, you get cost of goods manufactured. And then you can use the beginning finished goods, you know, plus the cost of goods manufactured, ending minus the ending finished goods, you can get cost of goods sold. So for manufacturing, it really takes many steps. So I personally think you may want to go back there. I'm trying to give you the textbook, right? Give you the textbook. So you have first to get the cost of direct material used, then you get cost of goods manufactured. You have a manufacturing cost to account for. You subtract the ending working process, and then you get cost of goods sold. Okay, that's all for chapter 2. Chapter 3, main thing is we talk about predetermine the manufacturing overhead rate, and then we talk about journal entries. First, some concept you want to know is there are 2 costing methods. One is job costing, one is process costing. When should we use which one? Process costing is for massive production, you know, for the crayon, for the same things. Job costing is you make for each job, right? This job can be different from the other job, so use job costing. And then the flow of the cost, this is kind of also important. You first is in the raw material. Once you use raw material, and then you have the direct labor, and then you have a manufacturing overhead. It will be work in process. And you keep working, it became finished goods. Once you sell it, it will become cost of goods sold. So that's the flow of cost. Now, how do we get the predetermined manufacturing overhead rate? It's important. We have to use, at the beginning of the year, we use the estimated manufacturing overhead, right? We use the estimated manufacturing overhead divided by the cost driver, estimate cost driver, like the manufacturing overhead is caused by machine hour, let's say. So you have to use the estimated divided by like 10 machine hours to get the predetermined manufacturing overhead. So once you get this rate, you will never use this estimated manufacturing overhead again. You don't use it anymore. So just to forget that, right? So later when you do adjusting journal entry, you never use estimated manufacturing overhead again. For journal entry, I don't want to talk too much, just go back to a note or textbook. The main thing is, I think, for direct labor, direct material, that's straightforward. You just debit the working process, you credit, inventory, or you credit the salary payable. But for the manufacturing overhead, when it happens, so like depreciation expense in the manufacturing department, when it happens, because it's manufacturing overhead, you cannot trace it to specific job. You don't know, hey, this job really cost how much manufacturing overhead when it happens. So you only put in the pool, right? We say, hey, you put in the pool, you debit manufacturing overhead, you have, I'll just make a number, like you have accumulated depreciation. You have that as credit. When it happens, you debit manufacturing overhead. When you allocate to each specific job, you debit work in process, and then you credit manufacturing overhead when you allocate. Remember, we had the pool. When it happens, you just save it there. When you allocate, you get the specific, you kind of use the scoop to get it out. And so you increase your working process, you decrease your manufacturing overhead. This is important, I think. I don't worry too much about other direct labor, direct material. And the last thing is, how do you adjust the manufacturing overhead? So your left side is always actual, your right side is always allocated. You will never use the estimated anymore, as I say, so never use estimated. For this situation, is your actual 700, you allocate is 800, so you over allocated, right? But more likely it's under allocated. So this situation is you increase manufacturing overhead by 100 and then decrease cost of goods sold. But if it's under allocated, you just reverse it. Increase the cost of goods sold and then credit your manufacturing overhead. So when I talk about this, I said when it happens, you debit. When you allocate it, you credit, right? You debit working process, credit manufacturing overhead. Make sure you get that one. Chapter 4, talking about ABC costing, I don't think there is really important calculation. Two main things for concept you want to know. First, we talk about the departmental rate. We said the plant-wide rate is simple but not so accurate. There are two situations. It's better to use departmental overhead rate. Read your textbook. I believe is in the textbook. I believe it's in textbook. Page, give me 1 second. It's textbook page 179. Okay, I'll just put it here. Page 179 there. And then second, we said, hey, even departmental is not accurate enough. It's better to use 4 levels of activity. It's based on activity. Unit level, batch level, product level, and facility level. Make sure you know those 4 levels is in the textbook page 190. So unit level is more likely you pack your this pen, 1 unit, you will cause more cost. It's related with the unit. Batch level is more related with, how to say that, machine setup, right? Once you set up a machine, then you can just have different many units. Like me, I open Zoom, then I can cover different chapters. That's batch level. Product cost is for each product, like for me, accounting 210. Okay, everything happened for accounting 210. That's the product cost. Facility, the whole manufacturing department, like rent, the insurance, those are facility level. So chapter 4 is easier, so make sure you read textbook, get those concepts. Chapter 6. There are 5 important things, actually 5 important things. We talk about cost behavior. I believe you feel much better now for the variable cost and the fixed cost regarding total cost and per unit. Variable cost is like a gas, right? For each unit, for 1 mile, it's always $2. So for each unit, it's constant. But the more miles drive, the total variable cost will increase. Fixed cost like car insurance, I kind of say the total is fixed no matter what you drive every month is $100. But per unit, the more you drive, you allocate lower, right? So the more you drive, the per unit will be less for the fixed cost. But in the reality, most likely is the mixed cost. So we have this equation y equals Vx plus the fixed cost. So you have to know this is fixed cost, this is variable cost, and then the slope is per unit. What's the meaning? So let's say y equals 2x plus 100. So that means every mile you drive, you increase the variable cost by $2, and the total fixed cost is $100. Why it's important? Because we can use it to make a prediction, right? We said, hey, in February, you drove 60 miles, then your predicted cost will be 60 miles, each mile is $2, so will be 120 plus 100, your predicted will be $220 for the total cost of the car. How do we get this? How do we get this equation? There are two methods. You definitely have to know those two methods. The first one we call it the high and the low method. So you get the high and then you get the low. So you get the slope by using y divided by x. And the second way is to use the regression. You don't need to perform the Excel. Make sure you just know how to read the output. How do you read the output? But for high and low method, you have to calculate by yourself. We did that in class. If you want to go back to textbook, it's on page 325. For the Excel, the example is on page 327. So I may give you this output, then I'll give you this. The intercept is the fixed cost, and the coefficient of x is just, the coefficient, the slope there. So if you read this one, you should be able to give me the equation will be y equals to 7.85x plus this. And then if I say, hey, when the x is 10, what's the predicted y? You should be able to do this. Regression is important, especially now we talk about big data, you have to do data analytics, so regression is important. Next one, last thing, in this chapter, we covered the two costing. One is absorption costing, one is variable costing. You do not need to know the calculation. I know it's too much work, you don't need to know the calculation, but you have to kind of get the concept. Here is what you need to know. First thing, absorption costing is for external. Variable costing, CVP analysis is for internal. And absorption costing is revenue minus cost of goods sold, get the gross profit minus all the period costs, get operating income. Variable costing, now I believe you are very comfortable. Revenue minus all the variable costs gives you contribution margin minus all the fixed costs give you operating income. Okay, so if I say, hey, gross profit, you have to know this is in absorption costing. I say contribution margin, you have to know it's in variable costing. The last thing you want to know is when your production is more than sales. As I say, you produced 10 units, you only sold 8 units, okay? You only sold 8 units. In this situation, your operating income under absorption costing will be more than variable costing operating income. Why? I don't want to say too much because you only expensed 8 units in cost of goods sold, so your cost will be less. That's the reason your operating income is higher. But under variable costing, you expensed all of the 10 units. So you can read your notes if you want to know why. But if you don't want to know why, you have to know this conclusion. Okay, on chapter 7 to chapter 9, I said go back to your exam 2, and then I would say I need to check whether you still can review your exam 2, yes or no. I would say really if you can review it. If you cannot review it, I will reopen it. If you can review it, definitely go to review your exam 2. You all did well. I think some questions will be similar, especially for calculation. I definitely will give you different numbers, but the logic should be kind of similar. For concept, I changed some, maybe in the exam I ask you, hey, which statement is correct? In the final review, I may ask which statement is wrong, but I would say definitely go back to review your exam 2, especially for calculation. I may have few new calculation, but most I would say at least 50% of the calculation will be similar, different numbers, okay, different numbers, but the logic is similar with your exam 2. So I'm not going to talk too much of those chapters. Chapter 10, 11, 12, those are the new chapters after exam 2. For each chapter, I think I posted some practice in the Blackboard for calculation. I have the same suggestion. Go to do those practice, especially for calculation, for all the variance, for all the ROI, for those RI, those things. You will see similar questions in the final exam with different numbers. Okay, it doesn't mean that I just see all will be in the final, or final will be all from this one, but I would say definitely go to look at those questions and practice, especially now you don't have a lot of time to prepare for your final. So start from there and then read your notes, read textbook, do my content lab, those things. Okay, but I personally would say go to your Blackboard, practice those practice questions. Chapter 10, talking about performance evaluation. Basically just 4 things, right? 4 things. First one is types of responsibility centers. Concept thing, I may ask you, some centers are revenue centers, some are cost centers, some are profit centers, some are investment center. So I ask you, hey, which statement is correct? I said accounting department is a revenue center. This is not right, because our accounting department, we don't sell things. We cannot generate revenue. So we are the cost center. All we can do is just saving the cost. So this statement is not correct. Okay, you need to kind of got the idea. Second part, talking about evaluation of the investment center. There are 1, 2, 3, 4 measures: ROI, sales margin, capital turnover, and ROI. So make sure you know how do you get the formula, how do you put in the numerator, how do you put in the denominator, or how do you put the ROI. Calculate, and then you kind of know we want those numbers to be higher, generally speaking. That means better performance. The third method to perform, the other way to measure your performance is to say yourself, right? To say your budget variance, to say, hey, you are doing better than the budget, yes or no. We always put the actual on the left side. We put the budget on the right side. And then in the middle is our flexible budget. So you always have 2 variables. You use the units times the dollar amount. Actual is actual times actual. Budget is master budget times master budget. But flexible budget is you use your actual units times the budgeted dollar amount. So the difference of actual and static budget, master budget we call it static budget variance. Then actual and flexible budget, we call it the flexible budget variance. Flexible and the master budget, we call it the volume variance, because the only difference is the volume, is the actual volume or the master budget volume. Make sure you know how do you decide the favorable or unfavorable. If your actual is better than your budget regarding to your operating income, that's favorable. If your actual is worse than your budget in terms of the operating income, then that's unfavorable. Okay, so let's put some words. If your actual revenue is higher than your budget revenue, that's favorable. If your actual cost is lower than your master budget cost, that's favorable. So it's in terms of the operating income. It's in terms of operating income. I don't want to go there to detail. You don't need to worry about what I said. I want to say the fixed cost. You always say it's 0 or under volume variance, but you don't need to know this one. You don't need to know this one. I think too much detail. I don't want you to spend too much time. You are already busy enough, last thing is balanced scorecard, right? Balanced scorecard. There are 4 perspectives. Your job is, if I tell you one measure, you know what perspective it is. Learning and growth, it has 2 parts. It's your employee and then your information system, you know. So if you have a good employee, you train them, those are the learning and growth. If they are good, then you will have a good internal business, right? You will have more innovation, you have a good operation, you have a good post service. So if you do well, customers will be happy. You have a good customer, you have a more market share, and then you will get more money, right? That's the financial perspective. So this is fundamental, go up to support internal, support the customer, and then you will get your ultimate goal of the financial perspective. Okay, your job is, if I ask you, hey, what measure, you should be able to tell me what perspective it is. Okay. Last chapter, I shouldn't say last chapter, but I'm not going to talk about chapter 12. We just covered chapter 12. So you should be able to know this by yourself. Chapter 11 talk about standard cost and variable. What is this chapter? Is basically, remember we said the flexible budget variance and then volume variance, you know, and then the main difference is the static budget variance. But in this chapter, we break down the flexible budget variance to more details, like a price variance, quantity variance, those things. We have 4 items: direct material, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. For each item, you have 2 variables, right? So your job is to make sure you know how to get all these variables and how do you interpret it. I would say definitely focus on direct material and direct labor. I personally don't worry too much about variable manufacturing overhead, kind of hard to explain, but definitely know the direct material and the direct labor. How do you get the variance? How do you interpret those variance? I just make up an example. I say, hey, you want to make this orange pen, and then you, based on the master budget, based on the standard budget, you know, get the color, the orange color is just maybe like $10 per pound. So that's the standard budget. But in the reality, you spend $11 per pound to get this color. In that situation, you will have unfavorable price variance. You will have unfavorable price variance. Sorry, the internet. Sorry, the internet just so slow. Okay, so in that situation, you will have unfavorable price variance. So make sure, how do you get the numbers, and then how do you interpret it? You interpret direct material and direct labor. The other thing you want to focus is the fixed manufacturing overhead, especially the interpretation of the volume variance. What does that mean? It means just if you produce the more units than the budget, you thought you will just produce 8 units, but you produced 10 units, use the same amount of the fixed manufacturing overhead. You definitely will see favorable volume variance because you produced a higher volume than the budget. That's it. I highlighted this interpretation in the handout. I think you want to review that part. Okay, so as I say, for the first chapter 1 all the way to chapter 6, you know, you want to go back to chapter 1 to chapter 6. That's our first exam. Maybe you already forgot those things, so read your textbook notes. Chapter 7 to chapter 8, that's your second exam. As I say, go back to review your second exam first, and then go to read your notes or textbook. Chapter 10, 11, 12, those are new chapters. my suggestion is practice in the Blackboard, and then review your manual, review your accounting lab, review your note or textbook. Okay, so let me know if you have any question. As I said, once I finish the draft, I will have a better idea of your final exam, and then I will share more details with you. One more time, thank you for the wonderful semester. I appreciate that. Thank you. Let me know if you have any question. And I apologize one more time for my bad internet. I don't know what happened today. If you cannot see some of the video, just let me know, email me. Thank you.